I'm pleased to kick off our Q&A session. Just to remind you, we do have, this is the streamed Q&A session, and then obviously we'll have the Q&A sessions with the groups after lunch as well. I'm going to take questions from in the room to start with, and then I think we've got a few queuing up virtually. For those that are listening virtually, just remind myself how you ask questions. It's the same system we use for quarterly earnings, so it's either *5, or I think there's a talk request in the top left that you can also press as well. And with that, who would like to kick it off? Andy? Sorry, there's a button. There's a microphone on your desks.
Well, hopefully you got me now. So it's Andy Sinclair from Bank of America. I'll keep it to two. First, just on cash, and I love the 8 billion holdco cash figure, so thank you very much for that. But just on cash remittance, I was maybe hoping for a little bit more, and just kind of trying to understand that cash remittance figure, perhaps given the actions being taken to optimise solvency, how much is there of that feeding through, and maybe if you could just split that 2025 to 27 cash figure into recurring versus one-off. That's my first question. And second was just on life and health. 5% CAGR, fine, but again, maybe felt a little bit prudent to me. Felt that, I mean, even 7% on the growth segments to me felt health and protection going well, unit linked, you'll get some market growth, inflation hopefully contributing to premiums on top of that. Maybe if you can just give us a little bit of colour on your macro assumptions behind those life and health targets, what you've got for markets, bond yields, inflation, etc. Thank you.
Claire-Marie, do you want to kick off? And then...
Yeah, okay, I do. Yeah, so I think so clearly on the cash side, so it's above 27, should be read at the target. So it's made of both recurring and some excess capital, but to a conservative level of excess capital remittances. So we are always looking, and clearly we are working on some actions there. So I think what you should take as assumption is approximately 1 billion of excess cash remittance per year. So I think one of the reasons you may read this number a bit as being a bit too low. I think what is super important to have in mind is that we have clearly optimized our portfolio, also from a growth perspective. And some of the businesses which today are actually growing faster are also coming with a lower cash remittance. So we did optimize the portfolio from that perspective, and that's why we have this cautious view on overall net cash remittance, again with some upside potential from my perspective. Then maybe clearly, quickly on the life before I hand over to Andreas. You also need to rebase a bit our life and health operating profit growth related to the GV with UniCredit. And you need to have in mind that the OP effect is much bigger compared to the net income effect as well related to this one. So it plays a bit into this trajectory. Clearly, and then we have some very big businesses on which it's always a bit, it's difficult to grow them massively, right? And lastly, you have this technical effect related to the CSM, where a lot of the growth we are doing will take a bit of time before they get earned in terms of operating profit. So you have also this technical aspect. But maybe when it comes to the more fundamental, you can comment further on this.
Yeah, maybe I just add and say I'm happy that you asked the question and say you want to grow more or us grow more in life. I actually appreciate that. But I think we really have to balance it, doing it in the right segments with the right capital efficiency and the right margins. So we are not topping the operating profit growth but we want to balance it with cash and other KPIs. And I think this is the important part. That's why we also have a bit higher target when it comes to unit linked and when it comes to, as Oliver said, protection and health, and maybe a bit less aggressive on other sides. And I think it's also fair to say we have one or two markets where we already have a super high market share, and we should not expect that we can that increase further.
And sorry, just following up on that, just any colour on what's the bond yield assumptions backing that, and whether higher or lower yields would have any material impact?
Do you mean for life and health specifically? Makes negligible impact.
No. So I think so basically we took central rate assumption with a dedicated basically timestamp, so nothing specific.
I think you can see on...
Is right. We take a very cautious view on the world. And
You can-
very cautious view on the world. And I think on behalf of our clients, that is highly appropriate given what's happening. You may say as a shareholder, where's your confidence? I think it's very important in these times where we have war in front of our door, not to think just about the return on equity, but the return of equity. So we may be being a bit conservative on certain of these items. The other thing I'd like to remind of, the only business that doesn't need capital to grow itself when you acquire customers or grow new businesses are run-off businesses. So just a slight comment, and I don't mean it in any derogative form, but you need to compare businesses that grow customers versus that grow cash from existing business that work only via price or higher timestamp in investment coupons. So we are really aiming at growing the customer base of the company. We're going to make very significant investments that we believe are going to be highly profitable, but they require some initial investments, also in capital, that we need to offset. But we are highly confident that you will get, as investors, a very strong return on that. That's very different from raising prices only, because you have a different capital consumption dynamic, certainly in P&C. I hope that's helpful.
Michael, I think you were next.
Thank you very much. They're very geeky questions. The first one is on trade credit. The accounting's slightly different, but you're kind of 17 points worse than the best in combined ratio. And in very rough numbers, that would be 400 million operating profit difference. And just wondered what the plan is there, what the assumptions are going forward. The second is on asset management, PIMCO. I think there was talk in some kind of journals or whatever that you might be buying out the minorities. I'd be interested in that. And then the third point, I spoke to Oliver, to you earlier, and you mentioned something really, really interesting about the cash, but I didn't understand it. And I just wondered whether you could explain that's part of the resilience, the kind of the cash buffers you have, which I think you mentioned a figure, maybe I misunderstood the 30.
No, there's a side comment around how we think about mapping cash flows and looking at risk-adjusted returns, then not only numerical or financial pieces. People can say, I have no liquidity risk until you have to take out the assumption that something is tradable. So one of the things we'll probably talk about the next few years is there true liquidity? When Christian talked about liquidity in bond markets, which is going to be a very important question in the future, we really have a principle that is matching cash flows and not just spreadsheets. So that was my side comment. On PIMCO, I can make it very short. We're very proud of PIMCO, and we'd like to own as much of PIMCO as we can, and that's it.
And maybe I can pick on trade. I don't know what are your reference numbers. We can discuss, right? Clearly, I mean, like Allianz Trade is operating at the highest level of performance, and we have a lot of elements to look at that we can discuss. It may be related also, to the fact that we always structurally have this approach of recycling as part of trade, which is a very important aspect of the way we are doing the business. But in terms of quality of the delivery, it's outstanding, clearly.
Ian?
Hi, Ian Pearce from Exane BNP Paribas. You spoke a lot about the links between life and asset management and the evolution of that going forward. So I think the obvious question is, do you need to be the owner of AGI in order to fully exploit that benefit and that trend going forwards? And then the second one is just on the commercial combined ratio guidance. If you could just give us an indication of which bits you're expecting to see deterioration on. Is it mainly AGCS that you expect to lead that decline, or is there something going on in trade and in the combined ratio as well?
Oliver, do you want to kick it off, Andreas?
Yeah. No, I think I can respond to what Oliver also said. Resonates that we are very proud owner of our asset managers. And I think both PIMCO and AGI play a complementary role, being it from a product or from a regional perspective. Also, I think we have shown in my presentation the close interaction between AGI and Allianz and our own networks. So I think this is very important to appreciate that. And as Oliver said, we want to grow in asset management. We want to grow our net income in asset management. So I would always say, well, in principle, we are open for strategic partnerships and further gain scale if it's value accretive, but it also has to have a fit from a strategic and cultural perspective, because this is super important for the long-term success. So that would be my answer to that.
So basically, when it comes to commercial, so as mentioned in our plan, we are basically maintaining our level of margin, so 90 to 91 combined ratio is what we, basically around 91 is basically the level at which we are planning. I mean, some level of softening, it depends a bit on the various years, but it's mainly coming obviously from AGCS, so the corporate and specialty business. We are also given ourselves flexibility related, as an example, to some of the very opportunistic businesses we are doing with Allianz Group, as an example, that are really related to certain positive situation in the reinsurance market that we are not tapping into continuing towards the end of the planning period.
I'm actually going to take, I'll take one of the virtual questions now because William has been waiting very patiently. So if I could take the virtual question, so from William, if you could have his line unmuted, that would be great. Thank you. Go ahead, William.
Hi, thank you. Apologies for my absence. I hope you can hear me okay.
Yes.
I did just want to come back, please, to slide F17 and hear a bit more about your views about interest rate assumptions and your resilience to that, because that slide is showing only 5% downside, but for a business plan that has 7 to 9% EPS growth, that's kind of quite a big number. So, what is your assumption about yields, and how do you feel about the fact that we've seen a very large drop in the Eurozone swap yield just in the past few months? I mean, it's already down about 100 basis points or so. So if you could talk a little bit more about, you've shown a downside sensitivity there, but, what should we be reassured about that the earnings can continue to grow even if yields have stepped down a bit, please? And then secondly, slide F09. Can you just help me, the management actions that you're showing that are reassuring? I'm still just trying to be clear in a simple way. Your SCR through this business plan, are you expecting it to be growing or declining each year? And could you try and put a number on that to just help me think about how much is coming from numerator and how much is coming from denominator? Thank you.
So the first question is on the interest rate slide, and the second question is on the capital generation walk exactly. Through to the 24-25, I think. Is that right, Will? Yeah.
Yeah, so basically, as part of the plan, we are clearly expecting our SCR to develop together with the growth of our business. Obviously, there are a lot of significant growth assumptions related to the business development, as you have heard from all my colleagues. So there is expansion both sides, I would say, both on the earnings side and on the SCR side. Clearly, without the levers we are pulling, we expect, and you see that in the +2 coming from 20 to 22, right? We are seeing twice less, more or less, growth of CSM versus of SCR versus operating earnings. That's the way you need to look at it. And then the additional levers will come on top. When it comes to the exact deployment year on year, I could really not tell you that right now. There is no particular drop of basically SCR consumption beyond the fact that, as I was mentioning, we are going to work structurally on some of our businesses where we will be looking at reducing their level of capital consumption. So to make it very concrete, as an example, today our Benelux business, as an example, is on the standard model. That's a business where we think over time we can move it to the internal model, as an example. We also have our Polish business, which is in the same situation, will be another example of that. And then we have the structural focus on the capital lighter product, as has been mentioned as well by Andreas, that will come into play. And
the interest rate sensitivity and how comfortable you are around the assumptions and outlook for interest rates, I think, was this.
Yeah, the 100 pips down and what does it do to
So, but basically, as mentioned in our plan, we have stress tested, so I feel comfortable we can deliver in the current interest rate environment, as mentioned to you. And then just to give you a sense of, I think then the sensitivity which are displayed on this page give you a good sense. And then obviously we have a lot of levers we can always work on as a board of management, right? In case of need, and that's what we are also aiming to do if required as part of this plan.
So, Will, that's a great question, actually. So our internal plan forecasts that without countermeasures, we significantly raise the solvency ratio. So we want to build flexibility further into the plan, and that's obviously before shocks. And it's very important as you compare that also across peers, look at the number, please. Again, sorry for the footnote comment, before management action and after management action. We show numbers before management action, i.e. the gross numbers. And trust us, we always build in enough flexibility to be able to offset some of these things. So the shocks are like-for-like shocks before management starts to work. That's as much hint as I can give you. All right.
Okay, thank you, William. Will, we'll stick with William.
Thanks, Will Hardcastle, UBS. I guess just to clarify, and this is just a really quick one, in the 7 to 9%, are you using forward rate curve assumption? Is that what you're assuming? But the main questions are, where are those inflation excess reserves today, and what would you need to consider? What would need to happen before you maybe consider releasing them? And then just trying to square a few of the moving parts. I think you suggested debt leverage is likely to remain about stable through the plan, but also that M&A capital distributions funded through the remittance. I guess just trying to understand, should we just expect debt to be used to increase the solvency ratio, or what is the proceeds? I guess that's a slightly facetious way about saying it, but what's the use of the debt here? Thanks.
So maybe I start with the last one. So our plan is not based on any type of, basically financial engineering, playing with debts against equity to basically deliver. And we are also not planning to sit on the capital, right, and not to basically create value out of the capital, right? So I also think that as part of, and what we will do typically is that on the way, when we are in the situation to have excess capital, we will be balancing our profile also against cash and so on and so forth. And basically, we will be returning if there is a need to return it. So that's really the way we are thinking about it. Yeah.
But it's a great question. So let me reiterate. On Moody's, we have the highest rating of any insurer that I know, right? Credit rating, the highest. And we don't want to go down on that. On Standard & Poor's, we have AA. According to our internal capital computation, we are AAA now, right? And I think it's true for a few others. So we are really running a very, very, very conservative ship. And we believe that's the appropriate stance for the environment we are operating in. And let me repeat what Claire-Marie says. We would not present you with a plan where financial engineering and increased leverage will produce higher earnings. That's not what we're going to do. So risk-adjusted returns will improve, not the returns will improve.
The question was on, I think it was for interest rate assumptions again, basically, which you can answer again if you wish, and then the use of when would we use the excess inflation reserves or not?
Yeah.
How they would be used.
So on the, I think like on the rates, yes, and then on the excess inflation reserve. So clearly, as I have mentioned to you, broadly, I think the excess inflation reserve is in the same order of magnitude compared to what we had mentioned to you in the past. It has moved in the shape or form, as I mentioned to you already, right, from short tail to long tail type of business, and it will emerge over time. So for me, that's just the right way to look at it. Also because, we have seen much more inflation compared to even what we were anticipating at year-end 2022, because inflation has been there longer than anticipated. So.
Yeah, and maybe that's also an implied question. I like the question very much because it shows it's very smart. We are not basing this plan on increasing runoff. Can I repeat that? So this plan is not based on Because of a hard cycle, we've been putting a lot of money aside, and now the plan says, we're going to improve runoff to X, by massively reducing reserves. That's not part of the planning, at least not at Allianz.
Andrew?
Andrew Crean of Autonomous. Could I ask a couple of things? Firstly, the 7 to 9% earnings growth, that I assume has some component of recovery in retail and then underlying growth in the business. What I'm trying to get a sense of is what the pattern over the years would be. Do you see the recovery in retail completing at the end of next year? And what is the exit growth rate once that's through the line? Second question is on footprint, on Asia. You've made a couple of moves there, or certainly income insurance, which has hit some regulatory buffers. There's been some chat about your Indian JVs as well. Do you see yourself as underweight Asia, and do you see this as an area which you need to close the gap on, and how would you do it?
I think, Klaus-Peter, do you want to take the first question?
Yes. We expect over the plan a GWP growth of above 7% in the retail business, so it's slightly above the average. And this is now, as you can see, significantly driven by the growth in policies. I was referring to it in run rate. We will get from new customers and cross-selling probably 1.8 million additional policies, and we reduce the churn, so another million, and that will really drive the growth. So it's 2.8 in run rate per year.
No, sorry, I didn't express myself. There's the 7 to 9% earnings per share growth across the group. Some of that is recovery in retail, some of it's underlying growth in all your businesses. I'm just trying to get a sense as to how much is the retail recovery and what is the underlying rate of growth, sort of, I suppose the exit rate from 27 onwards.
So if you look at it, I think like in the EPS CAGR walk I have been sharing with you, you can see that 45% is approximately coming from P&C overall, and within that one, we expect some recovery to come still next year on the P&C retail one, and then the rest will be stabilized. The exact number effect of this one into next year into the 45%, I don't have on top of my mind, but we can basically go back to you.
The Asia footprint, Oliver?
I'm representing Renate here. That's why I'm answering the question, who's leading very successfully. So in Asia, we do want to be much stronger than we are today, but we want to do it in a way that is economically sensible. So what we don't want to do is spend billions on buying bank distribution through upfront payments. Because when you look in certain markets, the average ROE of the life insurance industry is 3 to 4 to 5%. So this is what we don't want to do. To your concrete questions, Southeast Asia is the core of what we've been focusing on, and we will work on these things on a continuous basis. We also want to build a business that is economically very attractive, so we don't value it on multiples of embedded value, so really look at cash earnings and cash growth. By the way, in terms of capital efficiency, we also need to work. We have a very strong health business there, and then the spread business that we have is only supplemental to that, so we're trying to make it very profitable. So we're building that out. And remember, 80% of business in Asia is life and health, and only 20% is P&C, normal development. So we're doubling down on health and intelligent life products for that. In terms of your concrete questions, yes, indeed, we are in the process of rethinking what we do in India. We are by far the most successful foreign investor in property casualty insurance in India, and we intend to strengthen our position there from a position of strength that we have today. The rest we'll let you know over the next couple of months. But we consider India to be one of the most important countries for Allianz to grow and develop in over the next few years.
Vineet?
Thanks. So just looking at the lens from what Oliver recommended, which is the protection and the retirement, it seems from just looking at these slides that retirement is really growing much faster in terms of, your target profits. I think I worked out quickly, 7 billion going to 10, whereas the protection bit is growing a little slower. So I'm just curious, do you think, is it people are going to try to save more, or do you think you're trying to do something different there that should lead to a big shift in your earnings from this retirement perspective? So that's really the top-down question. Just one for PIMCO for Christian. So, when Manny Roman talked about alternative assets, I think 3 years ago, these slides were similar in the sense of revenue split was about 20%-ish, and you're at 23% now. And now if you're thinking of 30% in 3 years, it's quite a pickup in terms of how the last few years have been. Now, obviously, it could be that private equity would get more interested as interest rates fall. So I'm just curious to hear your thoughts on what really didn't happen that time and will change now.
Sure, I'll start with that. Yeah. Thanks. Well, I'd say alternatives at PIMCO is really starting to pick up steam, and especially because the market is kind of coming our way in asset-based finance. For the longest time, in private credit is much more monoline around corporate direct lending, where PIMCO is active. But the diversified private lending opportunity set, where we're seeing an acceleration of banks exiting from that space, first in the US, and now we're starting to see it in Europe as well. There, the opportunity set is growing, and client awareness of and interest in the space is growing significantly too. One, sort of in the absolute, because it's an interesting opportunity set, and also as a diversifier away from monoline corporate direct lending. So the growth will come in asset-based finance in multiple different ways. That will be in the asset type, but also growth is going to come from new types of clients, acceleration of insurance solutions, where we're one of the leading providers of capital-efficient insurance solutions in alternatives, sort of, think private IG type of exposures. That has grown quite well. And then also on the wealth side, where we're one of the leading providers of interval funds and semi-liquid products to wealth investors there. We have a number of interesting initiatives that we've launched in recent years and that we'll be launching next year as well, with leveraging some of the distribution and balance sheet strengths of Allianz as well. So we understand it is, there is a distance between here and there, but the reality is that it is a growing space for us.
Yes, Christian gave a good part of the answer, Vinit. Thank you for the question. But it's the key opportunity for us is to really open more distribution capacity for us. It's both the opportunity and the challenge. So the key thing is how clients can get to us, which is the right way to put it, because we get sometimes even more requests from clients to access Allianz products that we can field. So the key investment side will be the ambition for PIMCO AGI and our life companies that we have the products now. How do we allow them to be accessed by our interested clients? And we still have a lot of clients in Allianz that just have one product and we do not talk to. So a lot of the focus, Vinit, will be on how do we provide access for distributors and particularly clients behind them to these solutions that we have. So distribution, which is a lot of part, we showed the growth triathlon today, is going to be the key part. It's actually really the first time that Allianz in this history is systematically driving distribution strategy from the top.
Andrew?
Great, thank you. Andrew Baker, Goldman Sachs. First one, just on the asset management, the 8% third-party asset management AUM growth. You able to give a split of net flow versus market assumption within that? And secondly, on your solvency, so I think you've still got a target or a floor of 180%, but the 75% payout ratio is maintained above the 150% level. So just curious, sort of practically, obviously in a stress event, what would happen if you fell below the 180 level? Thank you.
So there's, I mean, clearly, like the 150 is really applied to the dividend payout. And that's really a strict level from our perspective. That's really clear. The target level is our ambition level, right? I think it's a very healthy level at which we should be operating, and it will obviously depends under which type of scenario we are under, right? And that's because that's really important for us that we can also operate with the right level of overall resilience. That will also come first, I think. That's a way to look at it. Then I think the exact split between between the inflows and the market and the market valuation, I just have a slight doubt in terms of percentage, but it's in the case of PIMCO, it's basically mainly only net inflows. Because there is no direction that has been taken when it comes to basically the appreciation of the market. Clearly, in the case of AGI, it's a slight combination of the two, and the exact split, I would say, it's 2/3, 1/3, something like that.
2/3 flows. But on the solvency, it's very important you understand this is not a static number, right? So I want to go back to this management action thing. So we don't sit there and let the number drop and then say, oops. So we have very clearly defined alert levels that you see at which actions take into place that under no circumstances, ideally, we'd ever have to go back to you and says we can't pay dividend now. And the great stress was actually COVID and the measures that had happened. Remember that we had a regulator that was very clearly stress testing our ability under very severe stress, some of them that you would call unreasonable, and even under those, we were highly resilient.
Hadley?
Thanks very much. Hadley Cohen, Morgan Stanley. Just firstly, a very quick clarification point. The cash remittance numbers, sorry, I'm just within the sort of 1 billion of sort of one-offs that you're talking about within that, are you already including the planned proceeds from the UniCredit JV, or is that in addition to that? And then on P&C, the growth rate, the volume growth there's a big uptick. It's a very ambitious target that you've got in that respect, and presumably that drives a significant uptick in pressure and intensity for the agents. I'm just wondering to what extent there's been any change in incentivization or how the agents are remunerated to achieve those sort of profitable growth targets. Thanks.
Claire-Marie and then Klaus-Peter.
Yeah, we have really a change in paradigm because we were incentivizing before basically on the basis of volume. In parts, we were incentivizing also on profitability. And we have now implemented in all the major jurisdictions very clear that the agents will only get an incentivization at a certain level of profitability, and that the incentivization will be very much curtailed if there's no net policy or customer growth. And we will develop that further, and that is so far accepted by our agencies, and we have huge agency forces. Just to give you some numbers, in Germany we have 8,000 agents, and it's contracted already for next year. We have in Italy 2,300, in France 1,800. So it's really that we have changed a huge amount of agency network to this paradigm.
And then to your explicit questions associated to the GV. So basically, we have not taken that into account. So really, our plan is really the logic of it is really the base case, given the structure of our portfolio and how do we expect this portfolio to perform in terms of cash. So. And that basically will be part of what I was mentioning to you, which is basically part of the upside, but also part of the flexibility in terms of basically value accretive capital deployment we intend to do as part of the plan.
James?
Thanks. It's James Shuck from Citi. I just wanted to return to Will's question a little bit earlier on in terms of the solvency generation. So the 22 points, can you split that into the sort of own funds generation and then the increase in SCR? Because one of the things that we notice about your own requirements for business evolution growth is that the capital requirements are quite strong. I think you've mentioned in the past that you're going to be focusing on reducing that. So keen to split that out if possible. And then secondly, again, thank you for the 8 billion liquidity buffer number. What does that actually mean, though? Do you have a target range on that? How much of it is distributable? Is there central pooling requirements in there? Just a bit more insight into how much of that is really distributable over and above where you need to be. Thank you.
Yeah. So clearly we have a target range. So this is, and that's why this average 8 billion is the level at which we consider we have to operate given the possible sensitivities we could see in our business, and also what may happen and what may be required, either if the market closes or if we have certain stress happening to our operating entities and we need to bring them at the right level of capitalization, et cetera, et cetera. So we have a very sophisticated, actually, way to manage these buffer solvency reserve. So from my perspective, what we need to retain is the fact that this is we are operating with such a reserve. This is conservative, and this is the level at which we will not distribute. So that's and here again, I think there are nuances to it associated to the stress testing we are doing now. Then I think to your other question, in the plan, in the natural development of the plan, we are actually growing faster the earnings compared to the STR. So I think towards the 22, we are developing with 6% more growth of the operating earnings against 3% growth of the STR. That's basically what is coming in the underlying. And then, as I mentioned, we will be further working on these other levers that should basically allow us to basically bring up this organic capital generation. There are also very interesting elements in the organic capital generation of the Allianz Group related to the fact that we have a fairly large life portfolio, right? And also part of our capital is brought by our policyholder. And so on this one, we do not earn organic capital generation, which is quite logical. And this base effect is quite strong as well in our numbers.
Yeah, but that's why, James, thank you for the question. It was very useful to ask for the own funds generation. That's particularly, as you know, very important for the German business, where the own fund generation is a key part to cover the SCR. So we're actually trying to bring down the sensitivity in Leben, and this is where it's most relevant. In other business like US Life, we showed you we want to create more reinsurance solution to actually reduce the absolute capital consumption because we have a different model. So you need to assume that Sconsets is a live and growing platform. Yeah? And we're just doing the first one. So if we have more time in the breakouts, we can then go into the various components of that drives. Claire Maria, however, I think gave you the most important hint, if I may repeat that in the speech, which is we, for various reasons of complexity, historically have left some of our important businesses that consume a lot of capital in the standard model, and that is pretty punitive in terms of ability to generate capital and, by the way, stream it. Yeah, and we're going to focus a lot of energy the next few months and years on trying to bring them onto the internal model. And as Claire Marie said, Benelux is a key example for to do that.
There's another question over there.
Thank you, Jochen Schmidt from Metzler. I have one question on the non-life insurance market in Germany. The underwriting results of some more regionally focused players were hit significantly by weather-related claims over the past 2 years, also due to tightened reinsurance cover. And do you think that this could lead to increasing M&A activity in the German non-life market in the medium term? Or do you rather think that these profitability issues will be fixed by rate hikes, which might offer the opportunity for you for internal growth? That's my question. Thank you.
I would say there's probably a two-step approach to it. First of all, the regional players, they lack diversification. They will do two things. They will do price increases as far as they can, But some of them, like the public insurers, also try to get more diversification working together on reinsurance. It is not clear if this is sufficient to really counterbalance the natcat trends. So I think we have to observe the situation. But first of all, it will be a driver for internal growth, and that's also what we think, that we have continuous rate momentum in non-motor retail.
Michael?
That's already the second question.
That's actually your third question, so this is your...
Okay, so I don't know what to say to that. They're not very difficult questions. The first one is, Claire-Marie, it says very clearly above 27. So I just wondered, maybe you can make us dream and give us how much more. And my very back-of-the-envelope calculation from what Will Hawkins and your answers is, if you grow the SCR at 3% and grow the earnings at twice that rate, you get an extra 1.5 billion a year. My numbers are obviously completely wrong. And if you start with 8, you get to 9, and 9 times 3 is 27. And a little bit more, you get very quickly to 30. And then the other question is related to that last question on natcats. So clearly, well, not clearly, but natcats is an issue. You're obviously very comfortable, but I think in one of the slides, the more recent years have higher natcat ratios. I just wondered if you can explain a little bit the resilience you see there. Thanks.
I think. So a very good point. I think, like, indeed, the slide was showing the retail portfolio, right? So it's a bit different when you look at the diversified global portfolio and you inject businesses like partners business and so on and so forth, which is much less cat-prone type of businesses. So what we have in the plan and is very much in line with what I had already mentioned to you, which is like this 3% natcat load, and then you have also part of this natcat load, if you want, which is also in the attritional, right? Which is a weather-related, that you could also see on that slide, which was part of the 4%. 4 percentage point. So that's but I mean, we fundamentally agree with you, and I think Klaus-Peter has spoke well about what we are doing natcat related, and maybe Klaus-Peter can come back to it as well to explain further what we are doing in terms of actions on the natcat side. Then I think the above 27 is indeed above 27, right? So I let you do your own assessment. There is options for basically doing more from that side. But again, I want to reiterate the element I was mentioning, which is related to the way our portfolio is developing as well, and the fact that we may need to fuel the growth to basically give a bit more leeway to some of our businesses, which is extremely important to do, because ultimately you will get more value out of that over time. So it's very important we strike that equilibrium the right way, and that's what you should read in that number from my perspective.
Should I add? I mean, we had until 2022 roughly 2 percentage points of natcat budget. As said, from there we increased it by another point. And as Claire-Marie was saying, we have weather-related, that's below 20 million, and that covers up for the rest to make up for the 4. And we are working really on 4 dimensions to get a better hold of natcat, and that's why we have these share of gross losses that are lower than market share. The prevention, perhaps the natcat warnings via text messages, we have already sent out millions. We can really address our clients by postal code and tell them, you have to expect this kind of weather, please take care. We are probably one of the first ones that did not only try to do natcat via price, but going back to the point of underwriting and require prevention measures. That means waterproof doors, windows in lower parts of the buildings, valves that stop flow back. The second is accumulation management is really at a high level in Allianz, and we provide even centrally tools that our operating entities can use to be better there. I was then saying that we really have detailed data on the hazard zones. And for example, in Germany, you can divide it by 4. Let's say 3 and 4 are really the zones where you have return periods of 1 in 10, 1 in 100. And we have really moved our portfolio very far away from this. Yeah? And we are trying to be predominantly in zones 1 and 2. And all of this together works. And together with this multi-year forward-looking, where we are creating the buffers in the budget, but we are not only keeping them in the budget, but we are pricing them through to the end customer. And this is important. So what we are pricing through is the 2 things. 1, the budgets, and second, the reinsurance costs. And I think that's the whole concept, these 4 dimensions, why we think we are ahead in the competition to manage the natcat.
Andy, you've got another follow-up question. This might be the last question.
Thanks. We're just going back to slide F10 from Claire Marie's pack, and where the business units are not named but lined up for life and health and P&C. Just wondering if you can give us any idea about what some of those, shall we say, lesser or underperforming business units are, and is that all fix, or does sell come into the mix for some of those as well?
Indeed, so I think on the P&C side, so I think in both cases, first of all, you need to have in mind that this is Solvency II ROE, right? So that's one measure that we are using to steer the portfolio overall, among many other KPIs we are looking at. Then it's a spot view. So typically, if you are a P&C business and you have had a huge natcat in that year, right, you will be in the low end. Does not mean you are a bad business, right? You just need to normalize and then make sure that this is addressed and priced the right way. So you have some of our businesses that are in that bucket on the P&C side. So I think on P&C side, to summarize, it's mainly either that effect or the effect of the need to work on capital intensity for some of our businesses because they are not reflected the right way, will be the case of Benelux. And also then further working on scale mainly. So as an example, you will have like the direct business there, which is just related to the fact that this business needs to gain scale to be at the level of profitability we expect overall. Remember, this is 18% on average, so that's quite high. And secondly, the Solvency II ratio is calibrated at 200% solvency ratio, so it's very demanding target as well, right? Then on the life and health side, it's also a bit of a combination of different dimensions. We have some businesses where obviously the Solvency II framework is not so friendly to the large traditional books. So typically you will have the French life case in that situation. Leben is doing very well even under that framework. And then you have businesses which are not reflected the right way under Solvency II, like Easy Life as an example, which is going with very high ROE, very high also cash remittance. So simply the profile under Solvency II is not the best one given the way it's reflected in our own portfolio overall. So you have a bit of everything, and we will be also further structurally working on all dimensions in the portfolios.
Okay. Okay, fine. Great. I think we're done on questions. Many thanks.